A simple thing, and some of you, may be beyond this, but a simple thing. We always get a chance to talk with a new subscriber, to talk with someone who's learning options new every week. Ernie and I relish these conversations. It gives us a chance to step back and say, I've got all these things in my mind about my calendar spreads, my delta ratios, my implied volatility ratios. Where are my married puts? What income method do I want to do? What economic report do we have coming up this week? Who's paying a dividend this week? Who's got earnings coming up this week? Hey, the Power Options portfolio tools are going to notify me of all of that because I'm going to have that all set up in the alerts columns and the alerts features. But every now and then someone just comes in and says, hey, I just started out. I'm looking at a covered call position and I don't get it. That's fine. That's great. That's why we're here. We have multiple videos. If you go to our YouTube channel, or actually if you go to our covered call tab, just click on covered calls and you have a link here directly to our YouTube playlist for the covered call positions. And that takes you to YouTube and you can see our recent videos that have come out. You can click on our playlists here. And of course, one of the ones that we have a variety of different ones for 0 days to expiration discussions, market hedges, technical analysis on power options, and then 8 or 9, 10 videos on different strategies: bull call debit spreads, collar spreads, bear calls, calendar calls, and of course, importantly, covered calls. Let's go to view full playlist. And this first one, which is about 1:33, is just a sort of a quick, slide video presentation with music in the background, not me talking, which some of you are thankful for because you hear me talking every week. But it's, which covered call strike price is the best? Well, if you go in the money, you get more downside protection, but you're going to get a lower % return if assigned. You get a higher premium because you're collecting intrinsic and extrinsic. And the at the money option, you're essentially all extrinsic, but you're taking advantage of the at the money bell curve. So you maybe have a good 4 or 5% downside protection with a potential good 4 or 5% return if assigned. And if you go out of the money above the stock price at the time you entered the trade, you're not collecting as much premium. You're collecting 30 cents, 40 cents, or 50 cents, for example. So you have low downside protection before you hit the break even, but you've got a high potential return if assigned, because you get the intrinsic gain to your strike price of your call, plus the small premium, 40, 50 cents I mentioned you collected. Now, that's just a quick one, but there's other ones: calculating the best strike price for a covered call. Why use in the money covered calls? How's the comparison work? What's considered conservative, moderate, and aggressive? That's essentially what we're talking about when you compare in the money covered calls, at the money covered calls, and out of the money. The in the monies are conservative. At the monies are moderate, right at the current stock price, selling a call right there for 7, 10, 15, 30 days out in time. And I would, in general, I'd consider an out of the money covered call aggressive, only because you have a low probability of being assigned and making the return. You didn't collect as much protection as you would with the at or in the money covered call, but you have a high potential of profit with a low probability of getting assigned and making that higher profit. Sort of the definition of aggressive, if you think about it: low protection, high return, low probability of making that return. But there's a lot to be said for using out of the money covered calls on a stock you're not planning on selling, you're holding long term, and you're trying to collect a dividend like income every 20 to 30 days. That's when I will use out of the money covered calls. Of course, those of you that know me know that if I'm holding a position long term, I'm using the married put approach in radioactive trading. But what the gentleman saw, and I'm going to try to find it here on the option chain. I might not be able to find it. I'm going to go 1 week out in time. Should stick with something more volatile, but I'm going to stick with Apple. And we're going to look at next week's series, the November 7th covered call series, and we're going to go to calls only. The reason, okay, none of them are here. I'm going to go 30% in the money. I'm on the small chain, so it's only going 10% in the money down to 247, which none of us would probably do. I mean, I could buy shares of stock right now at 272.41. Sell the 247.50 strikes. So we're talking roughly about, 25.09 in the money. And the midpoint's at 25.13. So I'd really only make 4 cents on this position. I get a 10% downside protection. Stock can fall 10% before I start losing money. If I get assigned, I only make 0.1%, but I've got, almost 99.9% chance of getting assigned in 7 days at 247.50 and making that 0.1% with a 10% downside protection in place, 9.2. Okay, fair enough. Call me out on that. It's 9.2%. But let me go to the 30% range. All right, and these are all pretty even. I'm not seeing anything I want. Let me try AVGO. That was the discussion I had earlier this week. But now that the market's closed, we're not seeing differences in price. There it is. That's exactly what I wanted to see. Thank God I called it. All right, AVGO, Broadcom, 342.46. I could go deep in the money, 7 days out in time, right now. Sell the 250 call for 92.18. I have almost a 27%, almost 30% downside protection. But I have a negative percent if assigned. The max return on the position with an in-the-money covered call that equals to the percent if unchanged return. That's why I like using the chain in these examples, because on our chain, we show you the calculations if you did these trades as a covered call or as a naked call or naked put. As a covered call trader, I'm focused on the downside protection, the premium I collected divided by the stock price. How far can the stock drop before I technically lose money on the position? The percent if unchanged. If the stock stays at the same price, what is my return? If it's an out-of-the-money covered call, it's going to be equal sort of to the downside protection. But if it's an in-the-money covered call, it's going to be equal to the percent if assigned. Because I'm so deep in the money, if the stock remains the same, I get assigned. Same as the percent if assigned midpoint. And, as I mentioned earlier, the probability. But I'm seeing a negative return here on this position. Why are we seeing a negative return? Well, it's based on the midpoint. Possibly the best return you could expect to get, or the best premium you could expect to get here. So we're talking about the 250 at 92.18. But I paid 342 for the stock, 342.46. And we're selling that 250 strike, right? So that means I need $92.45 just to meet intrinsic value, the value that I'm giving up from my stock price purchase to the call strike price. So my stock purchase minus the 250, my strike price of my call, equals the intrinsic value. The remaining premium is the time, of course, or the extrinsic value. I know, very simple, very basic, but these are some things that we need to review to make sure. Because when I see a negative percent if assigned, negative percent if unchanged, hopefully you never see a negative downside protection. That should never happen. But if I see a negative percent if assigned, negative percent if unchanged, or negative naked yield, that means the best price I could hope to get, the midpoint here, is below intrinsic value. I'm actually guaranteeing a loss on this position of 0.1% if I enter this trade, because I've got about a 98% chance Broadcom is going to stay above 250, but I did not collect at least the intrinsic value to make that profitable. Even though I had this good downside protection, want to make sure I'm getting a good bang for my buck. Okay. Now, there are other, of course, in the money positions here that are giving us what we possibly want. Most likely what I'd look for 7 days out in time, something with a good maybe 70, 73, 75% probability, looking to make 1.5% with a 5% downside protection. Actually, for a weekly trade, I kind of like this 82% probability with a 7.3% downside protection and a 0.8% return for a 7-day trade. I like those combinations. That's a pretty strong probability. But my mind's sort of jaded. Ernie's better at covered calls and the weekly covered calls. He'd probably point you to this direction. The 65, 68, 69% probability, good 1.5% return for 7 days, 5% downside protection. Hey, you're bullish on the stock. You study the stock. You're not expecting it to fall 5%. Anything can happen, but even if the stock falls 10%, you're only down 5%. You've collected that premium, that extrinsic value, that time value to give you a 5% downside protection on the position. So you have time to make it up. If you don't get assigned, if it drops below 330, drops down to 325, hey, you're still in a good, actually for the 10%, we'd have to drop down to 310. right? So you still will be losing 5%. You could manage that going forward. I said I'm jaded in a sense, but I'm a little bit more conservative because I focus on all the studies I did with my bull put credit spreads. I focus on the 85% probability range on the leverage trade, looking for a return of around 14 or 15% with an 83, 84, 85, 86% probability, where not my downside protection, but my percent to break even is around 8%. That's what I do with our weekly bull put credit spreads, sort of those picks of the day that we have there. That's based on the search that I put together. So probability is 86, 86.7. And there you go, 14.3, 13.3, 12.1%. And then the percent to break even would be around that 7 to 8%. These are 2 weeks out, roughly 28th of November. Happy Black Friday. Oh, it's already Thanksgiving and happy Black Friday, isn't it? Anyway, all right. So extrinsic versus intrinsic. I know, simple discussion. But again, just wanted to bring that up. You don't want to go as deep in the money as possible if you're seeing such a low return. You got to meet your trading goals. Got to still look for that good probability. But at the same time, of course, you want to make sure that you're meeting your annualized return goals and your protection limits that you want. If you want to be out of the money, hey, that's fine too. But you can always go to that covered call tab, check out the YouTube playlist I mentioned and go through some of those. Which covered call is the best strike price? Calculating the best strike price for a covered call, why use in the money covered calls, and then of course discussions on rolling, triggers for rolling, is there an optimum time to roll a covered call, and so forth. But starting with that, you see a negative percent if assigned, negative percent if unchanged on power options. You know the midpoint is below intrinsic value, which means you're going too deep in the money, of course, or it's just bad pricing at midpoint. You might want to look for a different strike or might want to look for a different stock as well.